You've reduced your debt and saved some money. Now you want to build some savings. Where and how should you invest it? Ted and I have some thoughts starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. Hi. I'm wearing a tie because we're talking about investing. So I have to look like an investment person.
Gotcha.
So
French cuffs or buttons?
I didn't even do
Oh, there you go. So
I didn't put a jacket on.
So you're working at a bank as opposed to an investment house.
Exactly. So someone comes into your office, they got a lot of debt, and they want your advice. What do they really want?
All right. Well, the first thing they want, obviously, is they want some kind of relief from their debt. That's what we do. But more importantly, they want some sort of plan for the future. You don't come into us just because you're feeling pressured from your creditors. It's you want to improve your life somehow. That's the real answer to all of this.
Yeah, there's an end game that you want to do. And so the typical person, I want to buy a car, I want to buy a house, I want to retire, I want to put my kid through school, whatever.
Yeah, that sort of stuff.
So that's what we're going to be talking about today. Now, there's lots of different savings vehicles. We're going to run through them really quickly because there are so many places on YouTube you can go to learn about this stuff that we're not going to try to do
we're not
that.
Really investment advisors either, right, folks?
we are not. And they say on YouTube, none of this is financial advice. Well, which is true with respect to investments. We're not going to tell you what stocks to buy. But let's just do the lightning round here. I am going to mention the thing. Right. And you're going to tell me, what it is, good, bad, whatever. So the most obvious one is cash.
Right. Well, cash is great because it's easy. It's in your pocket. Problem is you don't earn any interest on it, so it's not getting any bigger or any smaller. Right? It's just, if it's in your pocket, you're going to spend it.
Right. And you got a hole in your pocket, you might lose it. So there's a bit of a problem there. So the next level up from that would be putting something in a savings account.
Right. But that current interest rates, you get absolutely no return. I mean, it's just, what is it, 0.5 or?
Yeah, well, it's essentially zero. You're right.
It's not going to fall out of your bank account.
Right. There you go. So the next level up would be a GIC.
Okay. So that's a guaranteed investment certificate. That means you're saying to the bank or whomever you're buying this from, you can keep my money for this long. And because of that, they're going to pay you a better interest rate than you get in the savings account. They still pretty much suck.
Yeah. Instead of zero, it's, 0.1 or something. Right. So it's not a huge number. Okay. Then we get into stocks.
Okay. So now we're getting into more complicated stuff. Stocks, in my opinion, it's a form of gambling. So you're buying an interest in a company and you get your risks and the rewards are how well does that company do? It can go up, it can go down.
Yeah. So a stock, as you say, is a share of a company. And whether it's gambling or not, well, if you haven't done any research, then yes, quite clearly that's gambling. I guess if you've done a whole lot of research, well, maybe it isn't.
It's informed gambling.
It's informed gambling. Well, I mean, you and I both own shares in Hoyes, Michalos and Associates, Inc.
That's true.
So is that gambling? Well, I guess maybe you could say it was.
Nobody else can.
That's right. We're the only two shareholders, so there's nobody else there. So, and obviously there's a difference between a public company that you buy in a stock exchange and a private company. But again, we're not going to get into that in much detail. So the other thing, stocks are equity, bonds are debt.
Yeah, and bonds, it's a form of organized lending to either governments or corporations, businesses, that sort of thing. So you get a better rate of return than you do on that GIC or your savings account, but you don't get as good a rate of return if the company's really successful the way you do with a stock. So a bond is safe.
Right. So if I buy a bond and it pays 5%, then I'm getting 5% unless the company goes bust, then I'm getting nothing.
Unless it's a junk bond.
Right. And if the company does fantastically well, I'm still getting my 5%.
That's right.
Remember the old days when we had Canada savings bonds?
I do remember those.
Those were the days. They don't exist anymore, I don't think. So then we talked about stocks. The next level up from that is a mutual fund, which is what?
So a mutual fund is a pool or a basket full of stocks. So you don't have to research and know about the individual stocks. You just know that this mutual fund has X amount of dollars in banks and manufacturing and resources. And so it's a way to diversify your portfolio without actually doing all the homework yourself.
So you could buy a mutual fund that invests in the Canadian market or the U.S. market or bank stocks or tech or whatever.
All sorts. I mean, you can buy ethical funds. You can buy environmental funds. You can buy funds that only, buy stocks in companies that have blue logos. It's whatever they want to market it to.
That's what I want, blue logos.
That's right.
So then what is an ETF?
That's an exchange traded fund. So now it's just a more complicated beast, right? They have a block of accounts that they're dealing with. And they're the flavor of the month right now for investors.
Yeah. And so an exchange traded fund could be, we invest in the the TSE300 composite index, meaning whatever the stocks in that index are, we buy all of those stocks.
Right.
And it hits your diversification thing if it's a diversified ETF.
Yep.
But the reason they're the flavor of the month at the moment is the fees are a lot lower.
Yep.
So a mutual fund can charge 2% fees.
Right. And an ETF is what?
Might be half of 1%, could be a quarter 1%. I mean, obviously they're all different.
Right.
And if the stock market is capable, and I'm going to make up numbers here, so don't quote me on any of this, but if the stock market over the long term is capable of generating an 8% return,
right.
If you're investing in a mutual fund and paying 2%, you're only making 6%. That's what a 2% fee means. If you're in an ETF that is investing in those same stocks and it's only charging you 0.5%, well, then you're making 7.5%. So that's really why people are going to ETFs. They tend to be more robotic too.
Right.
The computer just decides, okay, we're buying all those shares in the index.
But experience has shown that if you're going to buy a basket of stocks that somebody else is picking, the ETF, it's just an automated process.
Right. And you're not paying as much in fees.
Right.
I believe, and again, I'm sure we'll get lots of comments on this, but I believe if you look at things like mutual funds where there is a stock picker,
right,
over the long term, they don't do any better than the general market, probably less with fees.
And your guess was close. Isn't the general market somewhere between 7 and 8% over time?
Yeah. I mean, the last few years have been a little different. So it's what is historic? I mean, right now we're in an environment of 0% interest rates. Although obviously they've started to hike up here in middle of or early 2020, 2022 I think is the year we're in. Okay, now the things that individual could invest in, TFSA,
tax-free savings account. So this is after-tax money you put in a savings account, and whatever you earn in that account isn't going to be taxable.
RRSP,
registered retirement savings plan. These are in pre-tax dollars. So this gets you a deduction from your tax return, but there are also some restrictions on what you can invest in. But the money that the RRSP earns also isn't taxed until you take the money out.
Yeah, and the key concept here is these are both buckets that you can put stuff in. So I can buy a stock and put it in a TFSA or in an RRSP. The difference, as you said, though, is with a TFSA, I've already paid the tax on the money and I put it in, and I don't get any further deduction for it.
Yep.
It accumulates tax-free in the plan.
Well, and it's easy to get money out of a TFSA.
You just take it out.
Whereas with the RRSP, it's more complicated.
Yeah, you get a tax break when you put it in, but if you take the money out, you pay tax on it. With a TFSA, you don't get a tax break when you put it in, but you don't have to pay tax on it when you get it out. And there's another big difference. We'll come to that in a minute.
Right.
RDSP, that's the final one.
Registered disability savings plans. It's specific savings plans for someone that's got a disability. You set them up for family, that sort of thing.
And I'll put some links in the show notes. The big Cajun man is the expert in Canada on this. He's talked about that on this show many times. Okay, so there's a whole bunch of different things I could do with my money. Let's go through the thought process here. And of course, this show is called Debt Free in 30. We've got on our mugs here. Mm-hmm. So let's assume that the one listener today is either debt-free or they've got their debt under control. Maybe they're in the middle of a proposal and they've got everything under control. They're ahead on their payments. Maybe their proposal or their bankruptcy's done. Maybe their only debt is, a mortgage, a car loan. So basically low interest type debts.
Right.
Maybe they got a bit of savings. So, okay, should I've saved a few bucks. Should I put it in any of those things you mentioned? A savings account, a TFSA, an RSP, a mutual fund, an ETF. What should I do with it?
Right. Well, so you're asking the wrong question. It's not where do you put the money? It's what are you saving the money for? You got to have a goal in mind. So if the goal is just I want to have savings, the answer is going to be different if the goal is I want to be able to put money down in a car next year. I want to be able to buy a house. My kid's going to university in 3 years. So you need to have some specific details of what you want to do with the money before we can answer this question.
Okay, so I want to save for my kids' education and I want to save for retirement.
Okay, so now we've got objectives that are both somewhat longer term in order, right? So I don't know, depending on how old your kid is, maybe they're going to university the next 3 years, 5 years, 10 years.
So let's say I'm 40 years old.
And why don't you use me? I'm 60 years old.
That's really old.
Oldest is 14 years old.
I don't know how that even happened.
So she's going to school in 4 years, and I want to be able to retire in 5.
Okay, you're in a compressed situation.
I'm done.
Here.
I'm not retiring.
Well,
ever.
Okay, so let's take your situation then. Yeah. So I've got a kid. Now, your kid is going to school and university in 4 years, which means she is
14
now. Okay, so not a whole lot of time left to contribute to an RESP.
Right.
Not a whole lot of time to contribute to your retirement either.
So if I was somebody just starting now, well, I'd be starting too late.
So, okay, let's say you're 40 years old then.
Okay.
And you've got, I mean, you could still have a 12-year-old kid at the age of 40.
Yep.
So how do I think this through then? I want to do both. I want to save for my kids' education and I want to save for retirement.
Well, we haven't talked about this yet. Before you start doing those things, I think you got to have some kind of emergency fund. And an emergency fund is just something you can fall back on when something goes wrong. I mean, most of the folks that come see us because of their debts, something has gone wrong. And it's not that they didn't anticipate it. It's it was something that they couldn't plan for or they didn't plan for. We all know at some point in our life something's going to go wrong and you need money. An emergency fund is designed
Well, let me
to do
make
that.
up a hypothetical scenario here.
Okay.
Let's say the government shuts everything down for 2 years.
That never happened, would it?
Okay, that's a silly example. But okay, maybe you're right. You lose your job, you have a medical problem, whatever.
Right.
So I agree with you. Number one thing is I got to have some cash available sitting there in my savings account, whatever. And that's the number one thing you got to do.
Yeah. And there are different arguments that people have about that. Some folks say you need 1 month. Some folks say you need 3. I tend to split the difference. You need somewhere between 2 or 3 months. Now, it used to be that people would substitute that emergency fund savings with I've got this, $10,000 line of credit that I never use that if something goes wrong. Well, the problem with that solution is once you use it, you've got to pay it back. And if something goes further wrong, okay, now I'm not much further in the hole.
Well, and what if the bank decides we're going to take away your line of credit?
Right. Then you've got no emergency
Yeah,
fund.
you haven't used it or we're going to raise the rates or whatever. Well, now I don't have it. If it's money in my savings account, then they can't take that away from him in normal circumstances.
You got to be disciplined enough that you don't touch it.
Right.
That's the hard part too.
And this whole concept of emergency fund, there are emergencies that I cannot anticipate, like a worldwide pandemic.
Yeah, well, you're going to blow the engine out of your car.
Right. Well, I can anticipate car repairs. I just can't anticipate exactly when they will be.
Specific ones.
So I know I'm going to have to replace the tires on my car. I don't know the exact day, but I can, roughly estimate it.
Right.
I know that I'm going to have to pay for Christmas. Well, I know exactly when that's going to happen.
Every year.
Birthdays and so on. So I guess it's kind of like a pyramid, right? I got my emergency fund that will work for anything whenever. And then I've got some specific savings because I know I'm going to have to do some car repairs and things like that.
Right.
So, I put $1,000 in my emergency fund, new tires for the car. Okay. I got, 6 months to save for that. That's another $1,000. I have no idea how much tires for car cost.
Yep.
Christmas is 8 months away. I want to save $500. So that's how much I got to save each that.
Right.
The kid's education is 8 years away and retirement's 25 years away. So this is where it gets interesting. Let's say I've got $500 a month to invest.
Okay.
Now, some people won't have anywhere near that. Some people may have more.
Yep.
But I want to put money into my kid's RESP, and I also want to put money into my RRSP. I got $500 a month. How do I decide how much to put where and when and all that?
Well, so you already identified part of that. So we've got 2 different timelines. When will the kid go to school? When are you going to retire? So you've got 2 different cues. The retirement's much further out than the school, so probably we're going to bias or put a priority towards the schooling at the start of this program. Well, then the next thing to think of, so what are the government tools that are available for saving for school? So there's the Registered Education Savings Plan, which is after-tax dollars where the government will give you additional top-ups and grants. There are lots of interesting incentives for these things. We don't want to go into explaining exactly how they work, but we can give people more detail if you want to.
Yeah, and we can put links in the show notes because it is somewhat complicated. At the most basic level, the government will give you a kickback.
Yeah, so at the most basic level, the government has said you can contribute up to $2,500 a year to an RESP, and they will give anybody who does that a $500 education grant. So right off the bat, you're getting 20% on your money. And depending on your income, you may qualify for additional government grants. The lower your income, the higher the government assistance. So there's an automatic win here. So if you're going to save for an education, you get 20% just by putting in one of these things. That's the place to start. So there's $2,500 a year.
And even if you have zero interest earned on it. You put in $2,500, now you got $3,000.
That's right.
And obviously they don't give you that $500 every year on the same $2,500.
Right.
You put in another $2,500 next year, you get another $500.
And there's a limit. Over the life of the plan, they'll give you a maximum of $7,200 a kid. So call it 15 years.
So, which gets back to your time comment then.
Right.
Your kid is 12 years old. Okay, well, I've really only got, assuming
6 years.
a limited time to put it in, whereas if my kid is 0,
I got much more time.
Then, okay, I'm going to plot this out over a 14 or 15-year period.
Well, go back to your example. So we've got $500 a month to invest, and we just said that the practical thing to do to maximize the government benefit is $2,500. So there's 5 months. That means we got 7 months that we can put towards our retirement. And you can decide whether or not it makes more sense to front-end load everything into one plan or the other. I mean, that's all a cash flow question.
But conceptually, it makes sense.
Right.
I'm going to put 5 months worth of my $500 into the RESP.
Right.
The other 7 months go into the RRSP. And I've kind of maxed out the RESP, which is my priority because I've got a shorter time limit to save.
Right.
And you're right. You could do it $200 a month, $300 a month, combine it, whatever.
Right.
I don't know.
That's all, but it depends on what, I mean, some people would like to see each of these things going up every month, so the psychology of it. Other people, I've got this one done, now I'm doing that one. And keep in mind, so you're going to get a tax refund probably based on your retirement savings plan contribution. Throw that back in the RRSP too, so now you're topping up more than your $500 a month because you're putting the extra in.
Right. But when you do that during the year, it doesn't really matter because you're getting a break at the end. Now, I guess the only difference to that would be if your employer has some kind of RRSP matching program,
right? Then
it would make sense to do that throughout the course of the year.
Again, it depends on, do they do it based on your contributions every month or do they do it based on your annual contributions?
So you got to, and I think I'll say it again if I haven't said it already, you got to do your own research on this.
Right.
We are giving very high level generic things. All we're trying to do today is give you the things to think about.
Right.
We're not going to tell you what to do.
Well, we can't because we don't know you well enough.
But my next question is, what should I do? So how then do I decide? So let's say my kids are like mine, gone. They're not dead. They're just not dependents anymore.
I would dispute that.
Yeah, anyway. Well, I don't know. I'm pretty dependent on them when it comes to some
technical stuff.
Yeah, technical skills. They're certainly stronger than I am. So let's say my decision is between a TFSA and an RRSP.
All right.
So how do I decide? Again, I've got that same $500 a month. Where should I put it?
So again, now it's going to come down to how quickly do you need access to that money and what are the consequences of getting it? So if you need this money as an emergency fund or you're going to use it to pay for Christmas every year or get tires for the car in the spring, then the TFSA is going to make more sense. You're putting it in after-tax dollars, so it's not impacting your tax return that way. Any money it makes isn't impacting your tax return, and taking it out doesn't impact your tax return.
So why would I not? So I need to buy new tires 6 months from now. Why would I not put $500 into an RRSP to do that?
So you put it in the RRSP, you're going to get a tax receipt for the $500, and then when you withdraw it, you're going to get a tax slip that gets added, and they're going to withhold tax on it when you take the money out.
So I put $500 in, I may only get $400 out.
You get $425 back because they withhold 15%.
Well, I guess if it's less than 5,000, maybe it's 10. But whatever the number
doesn't matter.
is,
they're going to keep some of it.
Right. And then when I file my taxes, well, I guess I've got an in and an out. So if it's all in the same year, it doesn't matter. But the other problem is I just pooched my contribution room.
Right, because you can't get that contribution room back in the future.
But with a TFSA, you can.
It's a rolling balance that you're allowed to have a limit.
Right. So with a TFSA, the limit this year is X number of dollars.
Yep.
If I put that in, great. If I take the money out, I can't put it back in this year if I'm already at my limit, but then next year it resets.
Right.
So a TFSA makes more sense if you're going to be doing ins and outs. Now,
and certainly for your emergency fund and for savings for all of those things that again, the tires, the Christmas, the vacation, whatever it is.
So why would I put money as an emergency fund in a TFSA as opposed to a savings account?
Well, so the interest or whatever earnings you get in that TFSA aren't going to be taxed. So depending on what you're putting the money into in that TFSA, and they're pretty broad investment vehicles that you're allowed to invest in, you could get a pretty good win. I mean, you're not going to get anything in a savings account.
Right. But I could also pooch myself because I put my TFSA in that high-flying stock and it goes down, and now I don't have the money to buy my tires. I guess the only argument, so let's say the interest rate is practically zero in a savings account or a TFSA.
Right.
I guess the advantage of putting it in a TFSA is it's a little harder to get out.
It'll take a little bit more time.
Takes a little bit, yeah. With a savings account, well, it's on my debit card. I just go to the bank and boom, I got the cash. Yep. Whereas with a TFSA, I got to transfer it from my TFSA to my bank account and get it out.
And then you take it out.
It's a little bit more friction there, I guess.
Right.
So, okay, the basic concept then is a TFSA earns the money tax-free.
Yep.
So when you take it out, you don't have to pay taxes on it. And the other advantage is it resets. So if you do need to take the money out, okay, I can wait till next year and then I can recontribute again.
Well, and I look at it even a more simple way. TFSA is short-term, RSP is long-term. If you know you're going to need the money in the short term, then the RSP is a bad idea. That's as simple as that.
Yeah, I mean, TFSA can be long-term too.
Oh, certainly. But that's not the kind of focus that we're putting on
but
right
an
here.
RRSP almost never is short-term.
Right.
I mean, I guess if I know that next year I'm going to be taking a sabbatical and travel the wilderness, I could take money out of my...
I can see you doing that.
Yeah, that's exactly. The guy with the tie traveling the wilderness. Right. So next year, I don't have any other income. I take money out of my RSP. My tax rate's low.
Right.
But even then, I've just blown some of my contribution room, which is why that tends to be a bad idea. Okay, so I think we kind of confused everybody with that.
Probably.
So let's take it one level deeper then. The most common thing people say to me is when they're going through a proposal, someday I want to buy a house.
Right.
And I go, okay, cool. We all, that's sort of the Canadian
it's still
dream.
the Canadian dream, yep.
Even though a 400 square foot condo in Toronto costs
Let's not get into this. Come on.
So, okay, should I be saving for that house by putting the money in a TFSA or an RRSP?
Okay. So the house is kind of a special category because you're allowed to borrow money out of your RRSP sort of as a loan to put down on a house. And so by doing that, you're not eating up your contribution room. You're not actually withdrawing money from the RSP from the government's perspective. You're paying interest to yourself because you have to pay that money that you borrowed back to your RRSP.
Right. So you're talking about the home buyer's plan, which we call the new home buyer's plan, because you only qualify if you were defined as a new home buyer.
Right.
Which is either somebody who's never owned a home before. And the rules are, again, pretty complicated. So take a look at it. If your spouse owns a home, well, then you're not a new home buyer under certain circumstances. If you owned a home 10 years ago and haven't owned one since, well, then you qualify as a new home buyer again.
We might both qualify for a new home buyer. You know that?
Well, not if your spouse owns a home. I think that's the rule. So this is why you got to do your
That's right. Got to do your homework.
So as we are recording this in March of 2022, I believe the limit is $35,000.
Okay.
So, and again, you can all fact check me. I'll put links in the show notes. So if I contribute, $5,000 a year to my RSP for 7 years and I build up $35,000 and then I want to buy a house, what happens? I'm taking the money out of my RSP.
Yep. So you're borrowing it from your RRSP. So there's no tax implication for you on borrowing it right away. But every year you're required to repay a portion of it. And if you don't repay it, then there is a tax implication.
Right. And the portion you have to repay is 1/15 of what you took out, which means you've got 15 years to do it. Yep. So if I took $15,000 out, I got to put $1,000 back in every year. And when I put that $1,000 back in, no tax break.
Correct, because you're paying back your loan. You're not making a new contribution. Now, you are still allowed to make new contributions, so you pay back what you're required to and hopefully invest more money in your RRSP.
Okay, so my question was, should I be saving through a TFSA or an RRSP to buy a home?
Right, and so most likely the RRSP is going to make more sense.
Provided you're a new home buyer and so on and so forth. Up to that $35,000.
Yep.
I guess once you've got $35,000 in your RSP, then, well, if your spouse is also eligible to contribute and you and your spouse are going to be buying the house together, then you can get $70,000 of potential.
And you'll need it to buy a house these days.
Yes, because $70,000 for a typical house in Ontario is not going to be...
You're 10% down.
Right,
yep.
It's not going to be sufficient. So now... let's say I've got a couple thousand, whatever the number is, I put it into my RSP, I get a tax deduction.
Right.
And then that tax deduction, I could, if I've got contribution room, put that into my RSP as well.
Right. That's what we were talking about a couple minutes ago.
Right. And that's when people ask me, how to go about doing it, that's the first thought that pops into my head.
Right.
You put in whatever you can to the RSP, you take your tax refund, and then put that into the RSP as well.
Yep.
So if you were in a 20% tax bracket and you managed to contribute $35,000 over a number of years to your RSP, you're going to get another 20%. How much is that?
$7,000.
$7,000. So now I've got $42,000 in my RSP.
Plus whatever it actually
it earned.
Yep.
That's why using an RSP to save for a home is not a bad idea. Now, if you have to save up $100,000 down payment, then the TFSA is a great place to be accumulating the other.
And frankly, folks, most people got to do both now anyway.
Yeah, because mathematically there's no other way
or the
to
bank
do it.
of mom and dad's going to help you with the down payment.
Well, which is how it typically is for a lot of young people. So, okay. I already made the comment earlier that a TFSA and an RRSP is a bucket.
Right.
So I decide to put money into an RRSP or a TFSA, but then what do I put inside that bucket? Is it stocks, mutual funds, GICs? What do I do?
All right. So there's three elements to this, and anybody you talk to should tell you this. So the first is, what's your timeline? So the longer time you have, the more options you have with where you put your money. If you need to get your money out quickly, you're not going to put it into, you're probably not going to put it into stocks or bonds or things that are going to take a few years to mature, right? And you're going to look at how much risk are you willing to assume. So if you need the money very quickly, you probably can't afford any risk. If you can let that money sit there for 20 years, okay, I can take a little more risk because I've got time to make up for mistakes that I make. The reason this is important, the more risk you're willing to assume, the higher your rate of return is supposed to be. And then the final aspect of this is how much effort do you want to put into this? Are you the kind of person that's going to put the money in there and then it's just going to sit, you're never going to look at it again? Are you the kind of person that's going to want to look at it every day, every week to make sure that they know what's going on? Are you going to play with the money that you've got invested?
Yeah, understanding how your brain works is pretty important here.
Right.
Because stocks are volatile. They go up, they go down. And if you're the kind of person who has the app on your phone and every day, I lost $46 today.
I got to sell everything.
Right. Then that's probably not a good place to be in. Yep. My advice is, number one, it's your money.
Right.
So you spend some time learning how it all works.
Mm-hmm.
We've kind of sketched out the very basics, but there's a lot to learn here. So it's your money. You might as well learn how to do it.
Well, and can I add to that? Don't do anything you don't understand. Like there's all sorts of people out there making commissions on selling you different investment tools. Make sure whatever you decide to invest in, you understand how it works because you just said it. It's your money.
Right. And which is why my second piece of advice is trust no one.
There you go. Yep.
Or at the very least, trust but verify. So when I'm sitting down with the advisor at the bank and they tell me, hey, we've got this
wonderful product,
wonderful mutual fund. Yep. Okay, great. Show me how it works. I'm going to go home and do some research. Yep. And I'm going to realize that you're charging me a 2% embedded fee that I don't see.
Yep.
And that's going to eat into my returns. So unless the returns are 2% greater than what I can do myself, then it's perhaps not that great an idea. Maybe I should be investigating ETFs or looking at other things.
Right.
Costs are huge.
Yes.
And so you got to take that into consideration.
Because none of those people are working for free.
Nobody works for free, which is why another option is to hire a financial advisor or a financial planner. And again, we've done shows on this. I'll put links in the show notes. I've had people like Sandy Martin, Chris Enns, Jason Heath on the show who are fee-only financial planners.
Yep.
You go to them, they work out an entire plan for you, and they charge you a fee for doing that. Mm-hmm. Doesn't matter whether you put your money in an ETF or a real estate, they're going to charge you the same fee. If you've got the money to invest and you want some help, that's generally the better way to go because you're paying exactly for what you need.
Well, and presumably they don't just have a BA in English and have been trained for 3 weeks at the bank to do that.
These are people who have the CFP designation, which is not trivial. It takes a while to get.
Right.
And they can work with you and explain, what the options are. If you go to the bank and you say, hey, I've got this money to invest, they're going to say, here's the mutual fund.
Right.
Whereas the financial planner might say, well, you could invest in real estate. Mm-hmm. You could invest in crypto. I don't know how many of them are telling you to invest in crypto. Let's
not talk about crypto today.
But we had to get the word crypto in here at least once.
Right.
So they will take a much more holistic approach to it. So I think it's, if you got $50 a month to invest, okay, well, you probably do it yourself.
And the only way any of that works is if you know what it is that you want to do. So now we're back to you got to have some kind of stated goals before you can put together a plan. You got to know where it is you want to go. So if I'm taking a road trip to California, before I can pick, I need to know where I'm going so I can pick which roads make the most sense.
Well, and so then what's your final thought on all that? Is it that, or is it, are we more on the discipline end of all this? How do you summarize all this?
So, I mean, you hit the one word there that we haven't used yet, discipline. The whole thing about investing is you've got to know yourself well enough to know, am I disciplined enough that this will work? So I'm talking to the guys in the lunchroom, and they say, you know what, you should be buying crypto because it's up and down, but if you play it carefully, you can make a fortune in a short term of time. Well, I don't properly understand crypto, so you won't find any of my money going to that. I'm a conservative investor. But it's you've got to know your investment style, your investment type, and your attitude. But it all comes down to discipline. You got to stick to the plan. Don't get impulsive.
And I don't invest in real estate.
Right. I
could.
Yeah, but you're on the record historically as saying it's just a bad thing to do.
Well, and like you say, I don't really understand it.
Right.
I mean, I understand what a house is and all that, but I don't know what areas I should be buying and how to get tenants. And it's just, I'm not interested in that. I do a whole lot of other stuff, which I am more familiar with. And so I think that certainly makes sense too. So, so my concluding remarks are, number one, congratulations, you saved some money. That's fantastic.
Right.
You've turned the ship around from being in debt to now saving. So that's fantastic. Number one, be careful, kind of echoing what you said.
Don't do anything you don't understand.
Well, and it's not what you earn, it's what you get to keep. So you gave the example of crypto because I know you're a huge Bitcoin guy. And, great. It went up 50% yesterday. Well, if I didn't sell it and it now goes down 100% or 80% or whatever, then I've lost it. So it's not how high it goes, it's what you actually earn on it. Do a lot of research. There's a lot of fake information out there, or a lot of biased information.
Yep.
So you got to do a lot of research. You got to look at a whole bunch of different sources, books and so on. Be cautious, take it slow.
Mm-hmm.
If you really want to be investing in the stock market, there's lots of platforms where you can play money,
right?
Test it out and see how it would
see
go.
How lucky you are.
And then, pay attention to the costs. And that's one of the big downsides to things like mutual funds.
Right.
Again, this was not a financial advice show. No. It was, here's a bunch of things to think about it. You got to figure it out for yourself and take it from there.
Yeah, I mean, it all ties into everything we're always saying to you folks. You got to have a plan for your money. And so when people call us, the first thing they want to do is get out of debt. And that's an excellent goal. It makes a lot of sense because as long as you've got debt, then the money you're making is going to pay the interest and the cost of borrowing on that money. Somebody else is making money off your sweat. When you are investing, your money's making money for you. So you're the guy on the other end of the equation. So the goal's got to be get rid of the debt, be able to invest your own money so your money can start working for you instead of for somebody else.
Yep. And it's difficult. It's a lot harder than it used to be where you could just put your money in the bank account and earn 6% and not have to think about it. You got to put a little more effort into it. But You're right. It's a lot better to be earning than paying out the interest. If you can get to that point, then you're golden.
There you go.
Ted, thank you very much. That is our show for today. If you're watching on YouTube, there's buttons to like and subscribe, and you know how to do all that stuff, right, Ted? And share it with your friends and everything. If you're listening on audio, we're on all the platforms, Spotify, Apple Podcasts, everything else. So please like and subscribe. And we appreciate your support. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30. 3.